I'm here at the Financial Services Council's annual conference with the Association's Chief Executive, John Brogden, who's just announced that one of the challenges on the FSC's agenda is action against insurance churning. One of the challenges you mentioned that the FSC has is insurance churning. Can you elaborate what's the challenge exactly?
Insurance churning is an abhorrent practice. What it basically means is that a very small number of advisors engage in a process whereby they take a client who may have only been insured with a life insurance policy for 12 months, 18 months. They'll take that person and they will replace that policy with another policy and say, look, I've got a new product for you, here it is. In doing so, that advisor receives one commission for the first product, another commission for the second product, which can be over 100% of the first year's premium, so it's a lot of money. But there's no difference between the policies. They're basically replacing like for like. Now, we think that's an abhorrent process. We think it is not in the best interest of the client. It has other problems in that it pushes up the price of insurance because insurers have to keep paying these premiums. Now, it's not a widespread practice, but it is important enough for us to take action on. Now, where, in contrast, an advisor is improving somebody's insurance policy, we take that as a different approach, and it's not really churning. So what we're doing now is engaging on a process to consult with the industry, consult with government and regulators to put in place a policy that reduces churn and deals with people who undertake this abhorrent practice.
Are you able to clarify perhaps what that policy would involve?
Sure. Well, we basically see in a broad outline that anybody who churns somebody from an insurance policy in the first 2 years of having had one insurance policy should in fact have to pay back to the insurance company. If an advisor does that and receives a commission, if they churn a client, they've got to pay back all or part of that insurance premium in that 2-year period. So that's part of it, but it's a broader policy, and we want to make sure that as an industry standard, it compels advisors and insurance companies to act in this way. We'd prefer self-regulation. The government's indicated that they're looking to us for a solution. We're not clear whether that's self-regulation or whether they'll take what we put together, review it and put into legislation. But it can work as a self-regulatory policy, and we believe that that is achievable. We'll have that discussion with the government.
What's been your members' reaction?
We've consulted widely with our members. We've also consulted with the FPA and the AFA, and there's broad support for this. There's broad support for us to deal with this problem, to eliminate it, and in doing so, to deal with the small number of planners who do this. So it actually has broad support, which is very pleasing. Now, we will move into the detail phase in the next 12 months, and that'll be important. But nonetheless, we start from a position of wanting this practice to be eliminated.
When do you hope this policy will be implemented?
Our plan is that it will be implemented in line with FOFA legislation. So we're looking at a timetable for implementation at the end of 2012.
John, thanks for having me.
Thank you very much.